Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Monday, October 2nd, 5:12 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we're in a mild correction, approximately 7% off of the late July highs in the S&P 500. Check the trend gauge over here. Market leadership really kind of fell apart 2 weeks ago. We've been rebuilding our leaders list since then. They're holding up okay, and we detailed on Friday's video, and it was supported by our weekend research that there are some reasons to see the glass as half full as opposed to half empty, despite all of the red arrows that you see on the trend gauge. We added the yellow sub arrow to market leaders after our weekend research. But as far as the short term 21-day moving average and the medium term 50-day moving average, all five of the major indexes are trending below there. Long term versus the 200-day moving average, we've got the Dow, mid caps and small caps firmly below. We've got the S&P 500 above. Also the Nasdaq 100, which showed big outperformance today. And this is one of the things we pointed out in Friday's video also, as far as what we noticed, as far as, again, the glass being half full, but also it kicked it up a notch today, and we're going to dive into that a little bit. So what just happened? Most stocks down. BIG-7, however, all positive, despite the fact that yields and the US dollar went higher. I guess that explains why most stocks were down. But the BIG-7, over the weekend, Goldman Sachs put out a research report saying that the BIG-7 were really less expensive than they've been for a while with their PEG ratio. We talk about PEG ratio a lot. It's price to earnings divided by growth. And their PEG ratio is about 1.3, while the average stock in the S&P 500 is closer to 1.9. So if you're looking for good balance sheets, a place where all those billions of dollars on their balance sheet are earning interest, because they can get a decent amount of interest out of T-bills or short-term investments, maybe that's the place to park money. When I talked about when we had the follow through day, which recently failed, I talked about what we would be looking for. And what I highlighted was a chart of the NASDAQ 100 as it was consolidating earlier this year throughout February and March, and how the relative strength line was showing outperformance during that period. I'm going to touch base a little bit more on that today, as that's what we saw. And if that's what's going to happen, we'll be ready for it. And I'll highlight what happened in the market earlier this year when that happened, so you can see the kind of eye-popping outperformance. So all in all, on the day, RG8, I also mentioned on Friday, all 8 of the RG8 were positive over the weekend, or were positive last week, despite some weakness in the market. Not the case today. They were all down. The average down 0.94%. This is our 8 growth ETF composite. S&P 500 barely positive, but RSP, this is the equal weighted S&P 500, minus 1.13%. NASDAQ 100 up 0.83%, but the equal weighted NASDAQ 100 was down 0.28%. Knowing the market the way we do, the immediate conclusion is that that the Magnificent Seven, the Big Seven, the Core Seven, whatever you want to call them, the 7 stocks that dominate the tech and the Nasdaq 100 and the S&P 500, all up on the day. These numbers just support that. The average stock down, Nasdaq 100 leading. Dow Jones Industrial Average down 0.2%. Mid caps and small caps really got hit today. Mid caps down 1.35. Russell 2000 small caps down 1.58. Oils did a big about face, and that the latest relative strength on oil looks like it's over, and really not just oil. All energy stocks hit today. I don't know if that's a weakening economy saying that, but oil, uranium, coals, all lower today. Global diversified 60/40, no help from bonds, but no help from foreign stocks either. Developed U.S. or developed foreign stocks index down 1.3%, and the global bond index down 0.59%, giving 60/40 global a 0.5% down on the day. In-house GROTECTION just down a smidge, minus 0.03%. We got stopped out on our single stock position, CCJ. It was a uranium stock, was outperforming until Friday. Follow that through today to the downside, broke to 21. We got rid of it. Small losses, got to keep the losses small. We'll hit the tail of the tape and charts of interest right about now. Let's get into it. Here's the S&P 500. This bar looks like a positive close. It's in the upper part of the range. Let's talk about overnight first of all. So over the weekend, the House and Senate came to a 45-day short-term funding resolution, so the government didn't have to shut down on October 1st. The futures gapped up on that. They were up on the S&P over 0.6%, the Nasdaq up over 0.8%. That was when I went to bed. By the time when I woke up, they were red and getting redder. We opened the day down 0.2 on the S&P, flat on the Nasdaq, and just kind of chopped around a little bit, and then a little bit of a false breakout here, approaching 1130, ran into 4300. We talked about this 4300 as the bottom range of that burrito layers of support. So as of now, and this is kind of following through from what we've seen last week, 4300 looks like a big resistance area on the S&P 500 now, and it needs to overcome that if the broad index is going to go higher. So we hit that 4300 and sold off hard, making a lower low, formed a little bit of a cup and then another cup, and then rallied to the highs of the day, the downside and being held by 4260. Let's go to a 30-minute chart here. I'm going to highlight this 4300 level. So broke down below 4400. This was with the gap down after the Fed on September 21st. We came down, tested 4300 and held, broke below 4300 the next day, tried to rally, failed, tried to rally, failed, tried to rally, failed, tried to rally twice today and failed. And this 4300 area is a key level on all of those failures or above and fails or break below and reclaim. So 4300 right now, a key area, this 4300 to 4340-ish level. That's really those multiple layers of support. We battled it out there, and for now, the bulls lost there at 4,300. So that's a 4,300, and then even if we get above there, all the way up to 4,340-ish is a level to be concerned about. So that's something that we're keeping an eye on, quite obviously. Let's go back to the daily chart here. The purple line, the ADMA. Before you can attack the 21 EMA, you first got to get above the ADMA and make it curl back higher. The S&P has failed to do that. However, the NASDAQ 100 got back above it Friday and failed, got back above it today and held. And on its pullbacks, got tested it several times and got back above it. This is a positive. I pointed out the relative strength line on the NASDAQ 100, how it's making a new high well before prices. Last time we were at this peak in price on the NASDAQ 100, on the relative strength line, price was substantially higher. In fact, this looks like it was about 19 points higher. Last time the relative strength line was higher back this way, we were all the way up at 388. So bottom line, this late May breakout, on a relative strength basis, the S&P has just gone sideways. I'm sorry, the NASDAQ 100 has just gone sideways on a relative basis, while price is slightly higher from where it was. The NASDAQ 100 leads up, the NASDAQ 100 leads down. During this pullback, the lead down hasn't been significant. In fact, just going sideways, this is a positive sign. This is the exact same thing that I pointed out while we were pulling back in February, going sideways. And then as we started to come up the right side, you've got the relative outperformance after the sideways outperformance after a big run up in January. So let's where this rally this year all kicked off was on January 6th. So let's take a look at we opened the year just going sideways, sideways to down for the first 3 days. The rally kicked off on January 6th. Let's go to a comparison chart, and we're going to set our dates to the day before, which was January 5th, and we peaked on this rally on January 2nd before we start, or sorry, February 2nd before we started going sideways. So I'm going to look at how did we perform from uh, January 5th through February 2nd on the Nasdaq 100. Pretty good, 19.17%. How did that compare to the S&P 500? Almost double that. That's a pretty good return there. And this is the type of outperformance that the Nasdaq can give you. Let's keep in mind though, we were coming off of a Q4 with the Nasdaq 100 where it was being sold off, and a lot of uh, tax loss selling was taking place during Q4 on the Nasdaq 100. So I'm not saying that this absolutely is what is going to repeat, but I do want to point out that there is a significant outlook for outperformance if what kicked off today continues during this, either the first 2 weeks of October while the week seasonality wraps up, or the last 2.5 months of 2023 when seasonality is typically very bullish. Let's take a look at a couple of other things to take a look at here. Um, QLD, this is double the NASDAQ 100. We took a second position in this today based on the outperformance. So we're kind of skewing our exposure away from the S&P 500 and more toward these big seven. So how did the individual big seven do during this month-long outperformance in January before we started to correct? Apple up 20%, Microsoft up 19%, Amazon up 36%, Google 25%, Meta up 49%, Tesla up 71%, Nvidia up 52%. So compared to QLD, which is 2 times the NASDAQ 100, which was up 40.6%, four of the stocks outperformed it: Meta, Tesla, and Nvidia. Obviously, Tesla and Nvidia are the biggest growth stories. Tesla with EVs, Nvidia with the AI chips, and they outperform the QLD. This is why we're kind of big proponents of QLD, unless these names are far outperforming. So the way to have played it during that run would have been to be in QLD and then added some Tesla and Nvidia as they were showing significant outperformance. Not saying again that that's going to happen, but right now we've got a thesis that portfolio managers may be looking to park money into these big seven as a way to make up their performance, hit their bonuses over the last parts of the year, and we're going to be paying attention to uh, that occurrence if it continues. Also, want to point out, while we were in this flat base, this 6-week flat base, the Nasdaq 100 pulled back 9%. The S&P 500 gave back the entire gain that it had, all the way up, starting from 3,800 up to 4,200, back down to 3,800. It was an over 9% gain and then loss before we bottomed here on 313-ish. We had a follow through day on 329, and that kicked off a nice rally until we topped here in late July. So as of right now, we've got a thesis to keep an eye on out for outperformance on the big seven. Take advantage of it as best we can. See if what do we need to see? Well, we need certainly to see uh, the Nasdaq 100 stay above the 80 MA. That is on an ultra short term basis, the first time that we've gotten back above it in 12 days. So the lows of Friday and the lows of today need to hold. Otherwise, that trade will be off for now. We'll regroup and we'll assess what's going on with the other leading stocks and leading sectors. And honestly, there's not a lot leading outside of the Big 7. There are some growth stocks that are holding up okay. There's a lot of former growth leaders that are bouncing either at their 50-day, their 150-day, or their 200-day. That's worth keeping an eye on because very often at those areas, portfolio managers come in to support those stocks, especially if they're value type managers. But S&P 500, what are we watching? Well, we can't get above the 80 MA first. So we are considering hedging our SSO position. We took another position in SPX. We added our SPXS today, or SPXU. They're basically the same thing. Until we get above 4,300 or above the declining 21 EMA, we're basically right on the 150-day. We undercut and reclaimed that yesterday. In fact, let me bring the 150-day moving average on here. And the 150-day, that's another kind of line in the sand that we use for determining what our exposure is going to be to the broad index. We undercut and reclaimed the 150-day today, and it was done very late in the day on the reclaim. So we're watching for that declining 80 MA and 4,300. Those are the two key levels. All right, let's move on to the rest of the indexes. Dow Jones Industrial Average making a lower low, but undercutting the low from last week and getting back above it, below all of its moving averages. Mid caps and small caps making lower lows, uh, just not good action below all the moving averages. And any minor relative strength that it showed last week was undone today, both on mid caps and small caps. Here you can see small caps undercutting in, making a lower low, big give back of the relative strength from the middle of last week. So those are the 5 major indexes. Let's go on to the VIX. VIX battling around between this 17, 16, and 19 level around the 200-day moving average. We want to see the VIX get back below the 21 and the 50-day moving averages and that 15 level. That's where the indices have been their healthiest this year. Let's go to the dollar. Not good stuff from the dollar, getting no help at all, making a higher high. So what looked like this might have been this evening star pattern negated by the gap up and higher close today on the dollar. And I bet you can guess how that impacted the precious metals. Lower low, gap down, lower low on GLD. These have completely fallen apart now. Also on GDX. For a while, there was a positive divergence where they weren't making a lower low while the dollar is, but they've now completely undone that and made the lower low. One exception to that, actually, Bitcoin, decent strength today, but closed in the bottom part of its range. It is above the flattening 50-day moving average and the curling up 21-day moving average. So some relative strength to Bitcoin, even versus the S&P 500 for the last 2.5 or 3 weeks. Something to take note of. Let's go to bonds now. Bonds didn't help stocks out either. Price making lower low on BND. This is the broad bond index. Also a lower low on TLT. This is the long bond index, and that means yields are higher. Here's the 30-year. Making a higher high, so that evening star negated again with a higher close. And this is kind of really eye-opening how strong this run has been in yields and in the dollar, and it's not at all good for the broad market. The Big 7 seem to be the only ones that are bucking that trend. TNX, let's go to the 10-year. Also a higher high as part of this recovery off of the May lows. Not good for stock investors. Let's go to RSP since we mentioned this earlier. That looks awful. This is, let's look at the S&P 500, the broad index again, how it is above its 200-day moving average. This is the equal weighted, which was all the rage last year while the BIG-7 were selling off in the fourth quarter. But look at the relative weakness there. We broke below the 200-day moving average here 2 weeks ago and made a lower low today. Not good there. QQEW, this is the equal weighted NASDAQ 100. Looks a lot better than the equal weighted S&P 500. It's still above the 200-day moving average. In fact, that doesn't really look bad at all. Still below the 21 and the 50-day declining moving averages, just the same way that the NASDAQ 100 is. All right, let's get to the tail of the tape now. You can pause this. Uh, Short-term spending bill passed. Uh, O'Neill, we were rallying strongly off the lows, and there was some talk about, is this going to be a day through follow through day on the NASDAQ 100, which is kind of crazy considering the way the average stock looks. But regardless, O'Neill rally attempt day 4 today, 12th day below the ADMA. Is it the 12th? Yes, it's the 12th day below the ADMA on the S&P 500 and the NASDAQ 100. Hold on 1 second. Let me get back to, here we go, back to Monday's data. As I mentioned, NASDAQ 100 above the ultra short term ADMA. Hey, it's a start. Or maybe it's not. Like I said, we know where our stop is for that QLD position. Also 12 days below the 21 EMA on the S&P 500 and the NASDAQ 100. So NASDAQ 100 showing outperformance. You can tell here what outperformed today. CKY, those are the 3 tech indexes along with semiconductors and software. On the downside, gold and silver stocks, coal, banks, oils, uranium, and utilities. Look at utilities. And this just screams higher for longer. Sometimes on a new quarter or a new year, odd things happen. The utility index being down 4.7% on the day falls into the odd category. And we've been talking for a couple of weeks about how maybe portfolio managers are just saying, why should I park money in these dividend stocks, which for the most part aren't cheap, and we can get a 5+% short-term risk-free yield in T-bills, and perhaps this higher for longer rotation into T-bills is, I mean, that's what we're doing at Revere. So why wouldn't other people do the same thing? So yeah, utilities, that's awful. Portfolio changes. CCJ, as I mentioned, all types of energy stocks sold off today. Uranium and CCJ, no exception. Our loss on the position 0.09%, well below the 0.2% threshold for a starter. CCJ, you can see here, harsh close, above average volume, just completely undoing the positive action from the prior 2 weeks. Back to the portfolio, we added to QLD on the relative strength, also added to SPXS on the relative weakness when we broke back below the 150-day, although it did reclaim it by the end of the day. So these, from a beta standpoint, these positions are kind of offsetting themselves, but we're getting relative outperformance on QLD. However, if we break back below the ADMA on QLD, that trade will be off. Bottom line on the day, the BIG-7 all higher while most stocks closed lower, along with yields up and the dollar up. Let's go down here to look at support and resistance. Here's that burrito support. There's a lot of it between 4,300 and 4,344. And we've been challenging that, and we failed right at that 4,300 level today, basically closing unchanged. We undercut and reclaimed again the 150-day moving average for the second time in 5 trading sessions. So we are seeing some support there around this 4274 level. Note that the 10-week, however, we key off of the daily, but the 10-week is actually up here at 4301. Let's take a look at the S&P 500 and a weekly chart, and you can see how we're just below the 30-week moving average there by 0.3%, and right below there is the 200-day moving average. Honestly, this big setup on the S&P on a weekly just looks like a big cup and handle, and we're putting the handle in now. And that 4,200 area uh, right below and or the 200-day moving average, if that acts as support and we bounce off of there, we'll be ready to re-engage the market. But we got to get a little bit more leadership. Can't just have 7 stocks holding up the market. Or can you? We'll see. And with that, I am going to wrap it up. So, as always, feedback, don@revereasset.com. Leave any comment in YouTube if you're watching us. Make sure to like the video and subscribe. Or if you want to email my partner about becoming a client, it's dan@revereasset.com, or you can call us at 855-REAL-WEALTH. That's 855-732-5932. Remember, it isn't about how much you made in the markets, it's how much of that you can keep. We're going back and forth between keep and growth mode. And right now we're keying off of growth stocks, the BIG-7, possibly growing, while the rest of the market, and certainly the value part of the market, uh, does not look good at all. One last look at SPLV. This is low volatility names just completely falling apart. So places that portfolio managers used to park their money to at least get a dividend because they would outperform in a down market, not happening anymore. T-bills are risk-free and paying much better in the most part than um, the dividend that a lot of these quote unquote value stocks are paying. And with that, I'm going to wrap up the video for Monday, October 2nd. This is Don Vandenbord with Revere Asset Management, telling it like it is. Thanks for listening and have a great day.